welcome to this event. Thank you very much for taking your evening to spend it with us. LSE.co.uk is one of the largest private investor websites out there. It's the first stop for most private investors. So we run these events for your benefit. We hope they're informative and enjoyable. We're only where we are, and the website is only as popular as it is, of course, from your patronage, so we thank you very much for that. It's great to see a very, very full room. Of course, this week we haven't got the World Cup or Wimbledon to contend with, which is absolutely a boon. Just to say a couple of things to say about lse.co.uk, just you've got a bit of background on the kind of stats we have and the kind of visitors we have to our site. In June alone, we had 922,000 unique visitors. Those visitors actually contributed and consumed 28.75 million pages, which I find quite staggering. 40% of that, approximately, was also looked at on mobile devices, which is a shift we've seen in the past few years. Moving to our presenting companies tonight, I just looked at some stats from the other day, some random stats, as it were, from the 9th of July. Columbus Energy had over 4,000 engagements from private investors on the 9th of July. Almost 3,000 of those were in our chat community. Reabold Resources were very close. They had over 3,000 engagements on that day alone from private investors. So again, I find these figures all stunning. Anyway, enough of me. I wish you an informative and enjoyable evening. There's tasty food afterwards, so I hope to have a good chat with as many people as I can after the event finishes over, as I say, a nice bit of tasty food. So again, thank you very much for coming along tonight, and I hope you have a great evening. Thank you.
Thank you very much indeed, Scott, and let me repeat that welcome to everybody here tonight. We're focusing on what really is a great sector for London and South East investors, oil and gas, and this, of course, at a time when we know that oil prices have been holding up, and we've seen successive companies, because of the fact that the oil price was much lower before, they've done a lot of cost cutting, and now they've done a lot of investing, and that's begun to show through in the performance of the huge variety of AIM-listed oil companies and gas companies that there are out there. And we've brought a couple of the most interesting ones to you here this evening, both with a great story to tell. And this also comes at a time, incidentally, where I see that the Financial Times says the outlook for new oil and gas projects is the healthiest since 2013. So we've really got plenty to talk about. And so we're just making a small change. Leo Koot, one of our guests here, his flight arrangements have changed. He's got to shoot off a bit earlier than planned. So while it obviously made sense to have the overview and then to hear from Leo, we're going to switch it around, and we're going to hear a little bit later from the other two. So let us turn immediately now to Leo Koot. Columbus Energy Resources explore, develop and produce gas and oil in Trinidad and Tobago and Spain, formerly known, some of you may remember, as LGO Energy. It changed its name in June last year, and its chairman here is an executive with over 28 years of experience in the energy sector. He's been involved in multiple successful business startups, including leading the refinancing and revitalizing of this company. So let's see what he is bringing to the Columbus party.
Thanks so much. It's always good to have these big engagement sessions. Thanks for turning up. I always like to have interactive events where, and very much to the disliking of Donald, but there he is. But if during the slides presentation there's a question, please shout, because I want to have a conversation rather than just a one-sided presentation. I've pulled a few slides from the AGM, which we had last Friday, and at the morning of the AGM, or the night before the AGM, a lot of things came together for us. There was a lot of hard work, 2 or 3 months we were all out, but then on the, I think 11 o'clock on the day before the AGM, we managed to sign the big deal for us. And then And I'll talk you through this. First, we're about a year into this adventure. I was asked to have a look at the LGO assets in early 2017. And when Gordon Steen, who introduced me to the company, said, well, look at the assets. Look only at the assets and don't start Googling LGO because then you'll walk away immediately. So I took his advice and I looked at Gudrun, which is an old field, but with a very interesting hydrocarbon history. And then I saw the Southwest Peninsula where there is a lot of prospectivity and opportunity. So I said, well, yes, I want to take this on. And then I started Googling LGO, and then I thought, well, there's a lot of history around this business, so we need to turn that around. So we need to completely change the face of the business, and that's when we decided to do a complete rebrand in June 2017. Columbus Energy Resources, that's what we are. We've completely revamped the business, and we started with a very clear strategy. So looking at the assets, bottom up, so what do we need to do with the assets to make this business successful? So the big timeline at the bottom, first thing we clearly had to do is turn it into a profitable company because LGO was losing a lot of money. So step number one. Step number two, I believe and continue to believe that there's a lot more headroom in Gudrun itself. So the free cash we generate, we reinvest in Gudrun to multiply, so to get the cash wheel going. That extra cash we can then use to grow our exploration portfolio in the Southwest Peninsula. And that gives then a great platform for transformational growth. And I'm glad to say the strategy is working. A year in, it is all going fine. So this first slide is a brief summary of where we were. Loss-making, we had a single asset in Gudrun, and that was it. The bold deal everyone talks about, that was not negotiated. So the Southwest Peninsula wasn't ours, really. There was a lot of promises and press releases, but it wasn't ours. So we started with Gudrun and a piece of Icarcos. Icarcos was operated by Touchstone. So the company itself had very poor internal communications. It was a reactive culture. People weren't stepping up to the plate and wanted to be accountable for their actions. And the Spanish government had terminated the license. So the company was not in good shape. So where are we now as of last Friday? So first of all, on the corporate and M&A side, we've closed we took out a lot of costs. So G&A slashed, we closed the big fancy office in London, and we're taking that even a step further, and we're closing the corporate office in London and only holding a small technical office here for our people, because there's no need for me to be in London other than meeting the investors. It's important to realize that the management team is very aligned with the investors. 50% of my paycheck is in shares. And you may have seen from the last press release, shares 5.1 pence. So with the current share prices, I'm not a happy actor, so that has to come up. We are cash positive from operations. And very importantly, with the Bold transaction, we have secured all of the Southwest Peninsula. And I've got a slide later on to talk a bit more about the Southwest Peninsula. From the organization side, we had Stuart Ahmed now in country. He's doing a great job. We are doing a lot of work on the infrastructure upgrades. But most importantly, we closed RED last Friday. What RED does, Project RED we call it, that was the code name within our business, which is the acquisition of Steel Drum Company. From one producing field, we now have 5 producing fields. So we've got Gudrun, we've got now, following the Touchstone deal, we've got Icarcos, we've got Trinity Innes, South Arran, which are all steady producing fields. turning out a lot of cash. And with those fields, in this new form, the whole business continues to be cash positive, even more cash accretive than we were before. So that's why this is such an attractive acquisition. The other interesting piece of the Red acquisition, the steel drum acquisition, is that it's got a development in its portfolio. The Koremuruga development, snow-capped field, which is going through the motions in government now to get its development license. But we believe that before the end of the year, we can have snow-cap online, on stream, and that's going to add more production and even more cash for the business. In general, we've more than doubled our production. We more than doubled our share price. So as a scorecard for the first year, I'm okay, but I'm never satisfied. I'm never satisfied. So this is a bit of a timeline of what we've done. I haven't talked about the Lind restructuring. People on the blogs don't like Lind, rightly so. The first deal was a deal which the company negotiated during a time of distress. The new arrangement is very much different, and I've got a slide on that later, and I'd like to talk you through that. It's very important to recognize that Schroders, one of the biggest and most reputable investors in London, are part of our share register now. And with the steel drum acquisition, we now have also got some Norwegian institutional investors. Pareto, they are the biggest shareholder in steel drum, so they're part of our share register now. So we're building up a nice balance of long-term institutions who believe in our story and believe in the fundamentals of the business, and a good spread of retail investors, which creates the liquidity in our stock, which is very important because people want to make money from the business. So this is a bit of a timeline, so where we started. So, this is the tip, the south piece of Venezuela, from Trinidad. And it is just 7 kilometers away from Venezuela. So when we started, we had Gudrun and we had 50% of Icaicos. A fair start. The first deal we did was Bold transaction, and with the Bold transaction, we secured our position in the Southwest Peninsula. We subsequently did the Icaicos deal with Touchstone, where now we are 100% operator of 100% owner and operator of Icaicos. So we've got the dominant position in the Southwest Peninsula. And then with the steel drum acquisition, we effectively created a string of pearls around the south of Trinidad. And this last slide shows you all the fields around us, mature fields in this mature basin. And you very quickly notice that here in Koremuruga there is a big piece which is underdeveloped and underexplored. And here in the Southwest Peninsula, there's a whole piece missing. I could talk a long time about why that is, but it's all to do with internal politics and who owns those licenses. But it creates a wonderful opportunity for us to really grow a company of scale based on production from the producing fields and the exploration opportunity within the Southwest Peninsula. I not only want to talk about the good, because the good is too easy to talk about. I always talk about the good, the bad, and the ugly. So what's good about our business? We've established a real strong professional management team, leadership team. There is a lot of horsepower on the team. Malcy, he knows Gordon quite well. He knows Stuart Ahmad quite well. And he's yet to meet Tony. But Tony Hawkins is also a star. And he effectively made the whole deal happen. So we've got a very, very strong team. With the steel drum acquisition, we've got a good shot at exceeding 1,000 barrels of production by the end of the year. And that's not ramping, that's not unexpected, but that's very, very achievable. With 1,000 barrel, your status changes in general, but particularly in Trinidad. You become a material player, and people cannot ignore you. So it's very important to cross that psychological barrier. You're not into hundreds, but you're thousands. Strong capability. I think that's the things I want to talk about. The good. Again, that's too easy to talk about the good. The bad. What am I uncomfortable with is that Gudrun production. It's a great field, but what we've done over the last year is we've added quite a bit of production, but the production is coming only from a few wells. If you look at 7 wells, produce about 50% of the whole production in Gudrun. And that makes for a fragile system, because if one of the wells is down because of a pump problem or if there's trouble with electricity, you've got a big gap in your production. So that is something we need to manage and move away from. The bad or the real ugly remains that we are dealing with an old piece of equipment. It's 50 years old. It's been run by the same people for a long time. And the people are tired. They're tired of working on this field because they've done it for such a long time. They can't see and they can't pick up the spirits and the energy we have believe in the field. So that's something we will be and continue to address. This is us. So have a look at the website. Dealing with the issue. So what are we doing? The bad, the fragile production position. Have a seat here up front. The fragile story around Gudrun is solved with the steel drum acquisition. We, from 57 wells, or 10 wells, we now are to 150 wells from which we get our production. And that, I expect that will be smoothing out our production profile and get rid of the big peaks. The ugly, again, the steel drum acquisition is a very good opportunity for us to maximize and optimize the organization. We're off to Trinidad. That's why I need to fly. We're right in the middle of a transition. And for any doubters out there, we will complete on this deal. There's no question in my mind. So this is going to be done in the next 2 months. And the transition is critical because that gives us an opportunity to, from scratch, step back, what is the right organization for the combined business, and then pick the people and put them in the right slots so that we get the maximum benefit of the steel drum acquisition. We've got already people in the fields now. We were doing fluid levels, and we're identifying wells which have got additional potential. So I'm confident that that's going to be a success. A bit on the Southwest Peninsula, already talked about, but the key numbers are that it's a large area, and we've got detailed seismic, and on that detailed seismic we see at least a dozen prospects. And these prospects range in size from 20 million barrels in place, oil in place, to one is as large as 400 million barrel oil in place. That's company making. If we hit one of those opportunities, because they all have that same range, if we hit one of those opportunities, our company will be in excess of $500 million. So that's where the $500 million comes from. It is in the exploration potential in the Southwest Peninsula. James, our geoscientist, always wants to put a seismic slice in there. And it is relevant because in this particular line, it's going across the Bonas field. So this piece, this disturbance is Bonas, and you can see similar disturbances deeper down. And this is a big structure. So if this big structure is oil filled, you can just guess the size of the opportunity. So that's where the big prize is from a organic growth perspective. The other interesting piece of the Red acquisition, the steel drum acquisition, is that they own 2 rigs. We need rigs to drill in the Southwest Peninsula, and with this acquisition we've secured preferential right to these rigs. So one is the Rolls-Royce. It is the best rig in the Caribbean. It's got a top drive. It's got It's built in Norway. It's Norwegian spec, so it's a very high spec rig, and that can drill wells cheaply to great depths. And then we've got the workhorse, which we can use on Gudrun to deepen some of our wells and to do more of the mundane stuff. This drills $3 to $4 million wells. This one drills less than $500,000 wells. Still very profitable. Lind, I already mentioned. This is probably the best finance structure I've seen in the last 10 years. First of all, it's completely contingent. So we've got an 180-day option to draw this money. So the interest rate is 8.5%. Well, a company our size, to be able to borrow money at 8.5%, that is phenomenal. And then the other thing is that in this type of deals, there's often a conversion right for the lender. But Lind can only convert at 8.1 pence, which is nearly double the share price of where we are now. So this is an amazing deal. And up until 8.1 pence, they won't be converting. So there's no artificial ceiling or headline. So what next? We talked about transformation and growth. One element of the grand transformation is coming from the Southwest Peninsula exploration, but it's good in life to never bet on just one horse. We've got a very strong management team, and we're good at doing deals. In the short time we've been working, we've already executed on 3 deals. So we've got a very capable team, and I want to release that team on more material opportunities, and this is significantly larger. The red deal, the steel drum acquisition was okay, but there are several projects in the pipeline which will again have the opportunity to transfer the business materially. The area where we're looking at is we want to use Trinidad as our operating hub, and we want to export that expertise we have into South America. Especially the top of South America, has got very similar geological characteristics, so that's where we'll be operating. Colombia, Venezuela, maybe later. Guyana, all land, and Suriname, all land operations. So where are we going next? Bonas reactivation, we have got a rig on there, so we're going to be building up production in Bonas. We're going to continue on Gudrun. Steel drum integration, which is critical. We want to be able to very quickly benefit from the incremental production we can see in that steel drum acquisition. South Air and Trinity Inn is a snowcap development. That is all organic growth within steel drum, and then mature the Southwest Peninsula to end up with big transformational M&A. This doesn't need to happen at the end. Anywhere where we see a right opportunity, Surface will step in. And I think that is the last slide, and this is where I open up the floor to question and answers.
Okay. Thanks, Leo. That's the story from him then. In my anxiety to get us straight on, I didn't just mention a couple of housekeeping points, which I'll do quickly. This is going to be put on video, and it'll go up in about 24 hours' time, our webinar, just so you're aware of that. If you'd like to ask a question, just wait for the microphone to reach you, if you would, so that people at home can hear the question. So who wants to ask Leo? One at the front, straight away.
And there's one at the back as well.
Yeah. Absolutely.
Thank you. The question that I like to pose is that what's the depth you're looking at? Because you've got 4 or 5 assets, and I just want to know what sort of depths you're drilling in.
The producing fields are producing from horizons somewhere between 400 foot deep and maximum 5,000 foot deep. So that's the current horizon we're operating in. The Southwest Peninsula could be material more. 70% of the opportunities, the prospects are in that same band. The bigger prospects are deeper, and we could drill wells up to 10,000 foot deep.
What lies behind your question? What was your concern there?
I just want to know how, as you know, it's very expensive. to drill beyond a certain point, and you need to make it cash effective. And the only way you can make cash effective is making sure that if you drill very, very deep, you can make the money count.
Okay.
Yeah, but I'd like to add to that. I'm not an explorationist by nature, so I'm uncomfortable with plain, straight exploration risk. So some companies go out to the market, raise $10 million and drill one exploration well, and then that's a roll of the dice. That's not how we operate. We will only drill exploration wells with our own free cash. So we will not go into the market and ask for money to execute on our exploration program. That's not the type of exploration we do. So we'll do a stepping stone. So we first be deepening a well in Bonas. If that's successful, then we take a more bolder step in one of the shallower targets and so on. So that we get to exploit our whole portfolio.
We've got another question at the back. While we get the microphone there, let me just ask you something I saw on one of the London South East share chat rooms. They were talking about possibly a lack of skilled labour and equipment in Trinidad. Is that still the case?
Trinidad faces some challenges. Trinidad is full of good universities, train good people, but then what often happens is that because the oil industry, E&P industry is a global industry, so that the A teams all get sucked up by the majors and moved abroad. So, and get to work on wells which do 10,000 barrels a day as opposed to 100.
Is that going to slow your potential delivery of some wells?
No. What we are doing systematically is we are training our own people. Our new operations manager is a young bloke. I think he's early 30s, but he's an amazing guy. He's got fire in his belly. He's hungry. He's got the same unrest and impatience as I have. So that's how we're building up the team within Trinidad.
Great. There's a question at the back, I think.
Yes. Can you explain your financial strategy here? As I understand it from you, that in exploration you're financing out of free cash flow that you have at the moment, and you have a standby facility of 2.5 million, which you may, the standby facility.
Standby, yeah.
Which you may or may not use.
Yes.
All your expansion up to now from what was a pretty dodgy company has been done out of free cash flow.
Yes.
Yeah. Is that how you're looking at expanding, or are you looking to borrowing, for example, for some of your expansion?
Organic growth, I believe, has to come from free cash. I'm a very traditional oil man, and I believe oil companies need to be profitable to be allowed to grow and to expand. Only when you've shown a track record where you can be proud of what you've achieved in organic growth, then you can go to the market and ask for big transformational funds. Because only then will the additional funds be accretive for all shareholders. And remember, I'm a shareholder as well. I don't want to be diluted. So the only new money coming into the company is money which is going to increase the share price.
Thank you.
And this Still Drum acquisition, is that putting pressure on finances in the short term?
No, but Gordon is a prudent CFO. He wants to be in a comfortable position where if a plane falls on top of his head, that he's not in trouble.
I'm sure we all share that sentiment. Any more questions? Yes, one in the middle here, just on the aisle.
Thanks, Leo. It was a really interesting presentation. I'm not a shareholder. I'm just here to get some general background. So I come from an operations background, perhaps similar to yours. So I'm curious as to why you want to produce more water, because in my view, water is bad. Bad for cost, bad for wells, and unless you want to re-inject it, then you've got to build a facility to take more water. So I'm kind of curious about that type of logic.
Yeah, I've got a similar background to you. I've got an operations background, and the business I was running in the North Sea Taka, Botani, we were injecting 400,000 barrels of seawater a day to produce 60,000 barrels of oil. So 400,000 barrels of water a day. So that business was a huge washing machine. So I know all about water-oil separation and making sure that that whole process is run efficiently. In Gudrun now, we like more water production because what we've learned from the initial water injection trials is that we're going to be needing more water than we've got presently our hands on. So if we drill a well, we are physically happy with additional water from that well. Why don't we have the traditional operational problems with oil-water separation? A couple of things. The Gudrun crude is remarkably light. It is somewhere between 35 and 55 API. So the moment you put a drop of our oil in water, it doesn't form emulsion, it just floats on top, like petrol or diesel on top of water. So it's very easy to separate. And what we do with the produced water, we use that as our main reinjection source. So that's important because it's a fluid which is produced by the reservoir. So it doesn't harm or damage the reservoir. It doesn't allow clays to swell. So it's a recycling system which we're generating, which is good for the environment anyway because we're not disposing any produced water to the jungle anymore. Does that answer your question?
Yeah, that's fine. Thank you.
More questions from the floor? Over there. And there's one over here after that.
Hello. One theme and a couple of questions around it. M&A, you talked about consolidation in Trinidad.
Yes.
There are a few small players like Range, Trinity, Touchstone, etc. If you did something with one of those, would that be a share deal or would you use cash? And the second part of the question is, would you consider doing something with Petrotrin, which I think has got quite a lot of assets that need to be better managed and better operated in Trinidad?
Yeah, if you look at the Trinidad environment, at the moment there are 18 different operators on land. So 18 for, I think, 10,000 barrels a day is way too many. So there has to be consolidation. This is one of the first steps. There's a lot more steps to come. The four listed businesses, so that is Touchstone, Trinity, Range, and ourselves, and our Predator 5, we've got a good relationship. So we team up, we share notes, and we engage government and Petrotrin together to the benefit of all. So first step is good cooperation, and then see where it goes.
And a question over here.
If I recall, wasn't there a difference in the taxation position for some of the sales, whether you are doing them onshore or offshore?
Yeah, that's a very good question. Thanks for that. Within land, within Gudrun, there are different fiscal regimes. Gudrun is an IPSC, so we pay not only royalties to government, but also to Petrotrin. So there's a double take for the government. Still very favorable terms compared to the rest of the world, but if you compare those terms with the terms we've got in the Southwest Peninsula, they're PPLs, they're private production licenses, and that means we've got a contract directly with the landowners, a bit like the US system. So if a farmer owns the land and the hydrocarbon, and they also own the mineral rights. So in that case, we only pay some royalties to government and some taxes. So a barrel in Bonas is twice as profitable for us as a barrel in Gudrun produced.
And that's where your big transformational area is.
And that's exactly where we've got most of our growth. Yeah.
Yes, thank you.
Yeah.
And a question at the front.
I wanted to find out what's the situation with the government. You mentioned there are certain challenges that might historically be there. And so how would you deal with what the situation might be in terms of government interference or challenges?
Yeah, that's a very good question as well. The way I look at it is that the country and the top level in government is completely aligned with us. We both want to produce as much oil from Trinidad land operations as possible and as economically possible. So if there are hurdles, which there is all over the world in the layers in between, there's ways to solve those hurdles by having the right relationship across all the layers within the government and within Petrotrin. Important to note that Steel Drum is better at doing that type of thing than we are. The Columbus team is very strong in commercial negotiations and everything to do with subsurface and operations. The Steel Drum organization has been very strong in building very good relationship with the government and finding ways where everyone benefits. So we are really keen to work with them.
So Steel Drum, how long have they been in the Caribbean?
Ooh, I'm guessing, but it's at least 15 years.
Any more questions? We need to let Leo go in just a minute. I think we've got one at the back. Keeping Donald fit, running around.
Thank you.
Yes.
Earlier in your presentation, you said that you'd be happy if at the end of the year you could produce 1,000 barrels a day. That would set you off as a different player.
In excess of 1,000 barrels a day.
I'm just wondering if what would you be happy with in 2 years, 3 years' time? And also in the answer to the gentleman's question over there, you said that there's currently 18 operators sharing about 10,000 barrels a day.
Yeah.
Would that be, are you looking to add to that or take their share or a bit of both?
A bit of both. We're still going through a transition process. So I haven't completely got my head around the new fields. I know Gudrun on its own can get to 1,500 to 2,500 barrels. With water injection working, so you would expect at least those numbers from just the current asset base. If you, however, take an exploration success into account in the Southwest Peninsula, then it's a multiple of that. If indeed the reserves are as large as we hope they are, then you look at similar production numbers as what the offshore operators are getting. Oh, there's 50,000 barrels a day.
Okay, and maybe just a final question from me. I mentioned the oil price at the beginning.
Yes, Malcy's a better guy to ask.
We've seen, well, I know, I'm not going to ask you where it's going, but I'm asking you at what levels you're comfortable with it. I mean, we've maybe seen so many different forecasts of a huge spike and then people saying it is going to get weak. I mean, what scenario would be difficult for you?
Oh,
how low would you need to go?
In Trinidad, you've got an odd tax called SPT, and I'm being very open here. And so in the zone 51 to 61, there in that zone, the oil companies don't get any benefit from increased oil price. So when we were climbing from low 40s to through the 50s, all the additional revenues were going to government. We're past that point now. So in short, the answer to your question is, as long as oil price stays above 61, then we're home and dry. Oddly, we would like it to be 49 than 51.
Okay, well, we'll start praying.
Yeah.
Thank you very much indeed. It's Leo Koot, ladies and gentlemen. Thank you very much indeed. You'll forgive Leo if he rushes off. He's got to get his plane to Trinidad via Heathrow. I think he was going to go via City Airport. I didn't know they flew direct to Trinidad, but clearly they do. Okay, so we move on now to Malcy. So we're going to get a nice overview of all this. So if we can kind of row back a little bit, that'll be great. Most of you will have seen Malcy's bucket list, which is a fascinating list that he does every year. He's really very good at picking winners. What he can't always tell us is when they're going to become winners. If we knew that, we wouldn't all be sitting here, would we? So let us hear from the man who has an unrivaled 30 years experience in oil and gas, widely quoted, of course. His daily blog is an excellent read. I was looking at it only yesterday. He's a founding partner of the independent advisory Hydrocarbon Capital, a director of Maven Income and Growth VCT4, Venture Capital Trust. Don't know what happened to VCTs 1, 2 and 3. Perhaps we shouldn't ask. He started his career at Wood Mackenzie, and he was an inaugural member of the #1 Excel-rated James Capel oil and gas team, taking us back a bit there. And let's hear from him now.
Thank you.
Sorry.
Maven 1, 2 and 3 are absolutely tickety-boo, as are 5 and 6.
Excellent.
Good evening, ladies and gentlemen. It's a great pleasure to have been invited here in such illustrious company to talk about the subject that I love. I've been, in August next month, I will have worked for 39 years in the oil and gas sector, starting as a graduate trainee with Wood Mackenzie in August 1979. And you've saved me from having to do the 10K, which is very healthy. And up there, you know, it's lovely to have two great oil men on either side, like a thorn between two roses. I've been asked to do a sort of swift run-through of everything. I'll give a quick run-through of the macro side to try and address one or two of the questions that I've been asked. Then we'll have a quick look at the bucket list. I've been given a bit of time, but more than happy to take questions at the end, or whenever you like, to be honest. The bottom line on the macro front, with Brent a little bit up to date, about 73, in West Texas at just under 69. The June OPEC Plus meeting restored, as we know, the November 2016 levels of production. At the time, the price was looking like it was going to exceed $80, much to Donald Trump's ire, when he tweeted to bring it down and told the Saudis to produce 2 million extra barrels a day. They can't do that. They might be able to increase their capacity by 2 million barrels a day. I think they could do 1 million in the short term. They put 500,000 barrels on already. In fact, they jumped the gun for that meeting because by the end of June, they were already producing an extra 500,000 barrels a day. And elsewhere, in terms of supply adders, they're the only meaningful amount. Kuwait can do a bit, the UAE can do a bit. We've got a bit of sort of come and go from Libya and Nigeria, which I'll mention. Libya could do more if it had stability, which it lacks at the moment. Nigeria just hiked a little bit after Shell lifted 2 months of force majeure. In Russia, they've added 150,000 barrels a day. They've gone over 11 million barrels a day, and they're increasing very slowly. The ghost at this particular party is probably what you've been hearing about in the last day or two, which is the potential for the president to release oil from the US SPR, the Strategic Petroleum Reserve. It's overfull to the tune of about 270 million barrels. They've got 660 million barrels in stock at the moment. The EIA rules and the IEA rules allow them to sell more down if they need to. It might be dribbled out, but I would have thought they'll keep this potential supply for a rainy day, in particular at the beginning of November, when Iran will suddenly peter out. Talking of Iran, if you're talking about where you are oil supply short, we know that they're heading for major supply export interruptions when those sanctions come into place. I expect about 1 million barrels a day to come off, probably a bit more. And you'll notice that one of the reasons for the oil price falling yesterday was that the two guys in the States said that they might do some waivers. There's absolutely no doubt they won't do any waivers. They might. One of them is traveling to India in the hope that they'll be able to say, I mean, the Indians have said that they won't be taking Iranian crude, but they do take a lot of Iranian crude. I would say that, as I said in the blog today, that waiver might be a question of saying, we'll give you a chance to change where you buy your oil from. Venezuela is still in free fall. No signs of a pickup there. Something drastic would have to happen there, and I don't expect it. There are one or two niggly places in the world where there are problems. The Syncrude breakdown in Canada has taken about 500,000 barrels a day off the market. Some of it's already coming back, the rest will be back in 2 months' time. There's a strike in Norway, which isn't affecting anything at the moment, but there are now 900 strikers off the rigs. It'll make a sentimental difference, not at all. Conclusion on the oil price is, while $80 was a tempter for OPEC, the danger of harming the long-term demand was an important factor which they took into account. The arrival of 1 million barrels a day, 500,000 we have already, should, all things being equal, keep oil in the $70 to $80 range. I expect significant demand in the second half, and OPEC production should roughly satisfy that. Stocks are obviously the key. Since 11/16, world stocks have substantially fallen as consumers ate into that excess. The cartel wanted those stocks down to what they call the 5-year average. They're now below that, and not including the SPR. The stocks should remain broadly the same at the moment. The dangers, well, the dangers on the upside that there is now pretty much no spare capacity in the system at all. Once Saudi are producing 11 million barrels a day by the end of August, which is what they say they do, and I think they can do, there's nowhere else to go if there's an outage of any sort. Once Iran is shut down successfully, the market will remain very tight. Any strikes, pipeline breakages, Libya problems or Nigeria problems would create problems. On the downside, I think 2019 might prove a more balanced market. The demand won't pick up much more, and I expect to see supply picking up a little bit in the US, for example. So the call on OPEC crude is probably going to fall a little at the at the beginning to the middle of next year. The key point here is that the OPEC Plus, as they're called, should remember how effective the 11/16 accord was, and they should realize then that all they have to do is discipline breaks down. They should go for, and they want to go for market share. That's where they're going to be in trouble. They know that if they just start rattling back production a little bit, they should be able to keep the price just where they want it. And I think that is $70 to $80 a barrel. Only other outlook problem would be, of course, significant GDP weakness in the US or in China. So, the outlook for oil shares is, I think, reasonably rosy in the sense that at the moment, and Stephen may disagree, but the outlook for the current market conditions for oil companies are about as good as it gets. 70 plus oil compares with most companies' internal models, which I think are done at 50, but more importantly, it's about costs. Since 2015, I reckon most companies have cut costs by between 50 and 70%, making margins way higher than they were when oil was $115. Look at assets that have been discovered in the last 3 or 4 years that are being developed at today's costs and today's high oil prices. And that immediately makes you think of the Cairn Far discovery, the world-class discovery in Senegal, Lancaster for Hurricane, and of course, Sea Lion for Premier and Rockhopper. Been watching the statements very carefully from the oil field service companies, because this is where the costs might start to hit, see how they're doing at the moment. We'll get interims in August from most of them, but the trading statements in June have generally been a good guide. There are some special situations, particularly if you bear in mind hunting, for example, in the US, where demand in the Permian and places has meant that they just can't sell enough from places like the Titan business, and prices have kept up with the strength of the order book. Elsewhere, I would say at the moment that the companies have been reporting good levels of business without significant price increases. Again, Stephen might be able to see more on the ground activity there. So margins are only slowly rising, and in the areas hardest hit, like rigs and seismic, are picking up, but only slowly. I think it's a good time to be an oil company at the moment. Could pass the water again. Just the glass that's already poured is great. Thanks very much. So the bucket list. The bucket list started nearly 4 years ago, I suppose. It started because a non-energy specialist, a guy who's currently chairman of an asset management business called Lion Trust, and he used to be head of Gartmore, knew nothing about the oil industry, but did know about what he considered to be commodity cycles always turn around. So he asked me to produce a list of stocks. It turned out it was starting to be a baker's dozen, but a little more than that, that would provide a decent return over a long period of time with a mix of betas, so investing at what he hoped was the bottom. Now, we did this in 2015, and obviously we didn't see the low until February 2016. But the plan for this list of stocks was meant to be, the companies are meant to have good entrepreneurial management, attractive portfolios with near and medium and long-term growth prospects, well-financed, at least in the area that they weren't dependent on partner cash calls, i.e., a bit low on cash, and all of a sudden your partner comes up and says, I want to do this, and you can't afford it, nor in a position where you have to rush to the market, because in those times, in 16 and 17, the market can see you coming a mile away, as you all know. The other thing they needed was, the list is geographically diverse. You've got stocks in there in the UK, in Norway, lots of Africa, Romania, Trinidad, South America, Central America, and Kurdistan. And the other thing is that, as you will know, is that one should be aware that the management should be aware of the needs of shareholders, particularly retail shareholders, because in the last 5 years, there has been a significant shift in power. Institutions no longer rule the roost. In some cases, we've had 3 or 4 years ago where institutions were holding 50, 60, 70% of the stock, and now it's over 50 or 60% in retail hands. Some managements are better than others at dealing with the message. So the bucket list, as you know, I'm going to whistle through it, and then we can take individual questions, or people can ask why wasn't something in, or why it was. But last year it was very disappointing. Well, it was disappointing in the sense that the oil price ran up, the bucket list didn't perform as well as I'd hoped. It didn't surprise me too much, because I know over the years that the sector always lags a rise in the oil price, and the investors need to have a significant confidence in the oil price. So, starting from the top down, in terms of how this is the interim performance. So we've got 18 stocks in the bucket list, and funnily enough, Rockhopper up 73.6 and Premier up 71.6 was the sea lion case. People, Rockhopper has been in the portfolio since the beginning for that very reason. It's taken longer than I thought to come out, but it's up 70% on the year so far. It'll be up significantly more, providing the oil price stays up and the team, in particular the Premier board, give it the FID towards the end of this year, which I'm expecting. Premier, of course, have got other fish to fry, and they're doing it very well operationally, with Catcher, Tolmount, and success in Mexico. But they only squeaked over the line in terms of financial strength with $2.5 billion worth of debt, because at the time I thought that operationally they were doing extremely well. Third on the list, obviously, was Hurricane, which I think speaks for itself. Technically, I probably should have taken it out of the bucket list last year in June when they raised $530 million and tried to put it back. As Nigel said, I am not a stock picker in terms of timing. I'm trying to talk about stocks which have got embedded value of a significant amount. Everybody in this room is better than me at picking stocks on a day trading basis, on a longer term basis. It's just, I don't deal in stocks and shares.
Do you hold any of these stocks before you put them on the list?
I hold no long, short positions in shares or warrants in anything on the bucket list. Years and years of being in investment banking and acting for companies meant that I was never allowed to. I always decided that starting, when the blog started to get so many people reading it, that the best thing to do would be not to hold anything. So no one can come up to me and say, you've given Rockhopper or Sound or Echo a really good plug, and have you just bought a few and then you're going to sell them tomorrow? And the answer is no. So back to Hurricane, it would, sensible people would have done that. I kept it in there because I believe it's worth a fortune. I believe in what Dr. Trice is doing with fractured basements. and we are going to find out PDQ, whether it's going to work or not. I did an interview with him, as you know, a couple of weeks ago. I sat down with him last week to talk about how things are going in Dubai. All the kit is on time, the FPSO is on time, sail away is on time, and it'll take 6 weeks to get to the site, to Lancaster, even including a stop-off in Holland for some kit. And I think that we know what the downside is. Fractured basement won't flow the 17,000 barrels a day off the EPS. It's a risk we all have to take. I think that I've seen enough of the numbers and the charts and everything else, and I've seen it works elsewhere. I'm taking the plunge and saying I think Hurricane is worth significantly more than £1 a share. And if I was a slightly risky and wealthy senior oil company, I would start buying a lot of shares in this company right now, because as soon as it does start to produce 17,000 barrels a day, and it does it for a period of time, and it could be as early as January or February. People keep saying to me, will they start early? Well, the thing is, once the FPSO gets on site, both the wells, as we know, have been primed and ready to go. So it will not be long after that. Bob Trice says 6 to 12 months after that it'll be proof of the pudding. I think people won't take that long to work it all out. And of course, the next success story in the list was FAR. I don't know how many of you have any interest in FAR. It's an Australian quoted ASX stock. I think it's worth an absolute fortune because it just hasn't had the chance yet. It's up 47% this year now. There's two reasons for that. First of all, obviously, people taking into account the value of its holding in the Senegal find, and that's big. And of course, there's arbitration going on at the moment. There's no downside for FAR in that arbitration because it's trying to decide between Woodside and Conoco how the JV agreement worked. But also the Gambia, which not many people know about the situation in the Gambia, but it is adjacent to Senegal. It's in the same, on the same line, and it's quite possibly a very substantial, very, very big target for FAR, and they'll be drilling that at the end of this year. So we've got FAR in there, and I think it'll do a lot better. The next one up was Pharaoh, which you know is a very much an old favourite, a bit in the mould of Ithaca. They're successfully drilling all the time, crafty dealings in the asset market. When they find something, they develop it, sell off a bit of it, and develop the next. They always in the licence round, particularly in Norway. And of course, DNO bought, first of all, 17% from Delek, then another 10%, another 3%. They've got 28.23% of the company, and then they raised $500 million in a bond issue. So Pharaoh is copper bottomed, and of course the next one was Echo, which is up 32.5% since February. Echo was almost borderline about whether it should go in at the time, because I thought most of the Echo story would happen in the middle to the second half of the year. But having interviewed Fiona and realised there were a few things coming up, in terms of workovers and 2 or 3 rigs. If these came in, I thought it would be very successful. Took the plunge and put it in. I'm interviewing Fiona on Core Finance tomorrow, by the way, so we should have an interesting chat tomorrow about what's going on. But I think there's masses of upsides there already, and they haven't even gone anywhere near the big stuff yet. So after that, we've got SDX, which was actually in the lead at Christmas. SDX is, as you know, Morocco and Egypt. Took a trip out there to the Moroccan assets a few months ago. Paul Welsh is doing a fantastic job there. I mean, that Moroccan business is making money like it's going out of business, because they are finding they've sent 7 out of the 9 wells they've drilled this year have been successful. In particular, the 2 northern ones, which were both ranked wildcats, both came in. So they're going to get up to their 50 million scuffs, and they will make significant margins. Just to give you an idea, the gas price in Morocco is controlled by the government and it's just moved up to $10.50 an MCF. Their costs are about 50 cents an MCF, which tells you how much money they'll make out of that. They've got a big industrial zone there. They've just signed up Peugeot. And so, I don't see any problem with that. In Egypt, there's another announcement yesterday from South to Souk, and they'll be producing all that by the end of the year as well. Next up was Reabold Resources, up 20% since February. You're about to hear from Steve, so I won't go into any details there because I'm very impressed with what Sachin and Steve have done. It's probably the quickest from meeting a company to getting into a bucket list, but I really believe in what they're doing. I think the model is fantastic, and through Karelian and Danube and the Gaelic Resources, I think there's lots of upside in the second half. Next up is Savannah. I missed Jersey. Jersey Oil and Gas. People ask why it was in the bucket list, and because a lot of people say, look at the bucket list, and it's a list of favourite stocks, and I want to pick one here and there. It wasn't the idea to begin with. It was meant to be, buy all these and you should do okay. But why was it in there last year? Because it was a rank wildcat, one-off only well in the North Sea. And if you remember, when it first drilled, it looked like it was a failure. And Statoil, as it was then, had a lot of confidence that it was worth doing the sidetrack, and it was. Don't forget, this year the well is going back as an appraisal well. They've just done a huge amount of seismic in the area. Absolutely certain. My contacts at Equinor, as it's now called, are telling me that they think there's more than just the 2 or 3 other exciting things on that license that Verbier is on. And I'm absolutely confident that Jersey is too cheap. Savannah is way too cheap, to be honest. I mean, I think that Steve at Andrew Knott is doing a great job there, but I think it's being held back a little bit at the moment. I mean, there are two parts of Savannah. One is the Seven Energy acquisition. Very few people would have gone to all the hard work that the Seven Energy acquisition meant. It was months and months and months of putting all the bits together, the lawyers, the debt was a mountain, and that was the reason why it was almost bust. But he could see 30,000 barrels a day, enormously profitable mid-cap business, and I think that the worry in the market is that it would be more expensive by now if they had completed the deal. I still speak to people who say, I'm not sure that's going to complete, it's not going to work. And I think that I spoke to Andrew last week. I'm absolutely convinced, like he is, that it will go ahead. And then, of course, the other side of the business is the Niger drilling program, which, of course, has started to become successful. And they are also talking about an EPS system where they can start bringing on production. And I think they'll get cash flow by the end of this year from there in a modest amount, and then more in due course. So, I'm convinced that if you put together the Niger discoveries, the Seven Energy with the upstream and with 20% of AccuGas, they're going to be in a very strong position. Trinity exploration, Leo mentioned in Trinidad. It's up 5.5%. It probably would have been more if it hadn't had quite a substantial raise recently. And I know I had a lot of inbound about whether that raise was sensible. They raised 20 million in order to pay back debt, sort out all the the debt they had with the government and Petrotrim when they had some difficulties. More importantly, it refinanced the convertible. That would have been most uncomfortable next January, so they had to do it. They've done it, and I think they're pushing back down the steps a little bit, but it's in very good condition. It is building production. It's the highest margin business in Trinidad. They've got potential East Coast asset called Galeota, which could be a company maker. So I think there's lots of upside from there. I know I'm running short of time, but we've got the baddies to go. Amerisur, which I get a lot of inbound from. I don't genuinely understand why Amerisur is this price, because the only reason it could be is because I think they've been saying they expect 7,000 barrels a day by the end of the year, and they're only on 5,000 at the moment for production. But they are working on production onshore, and they've got 3 most exciting wells coming up. They've got the end sand anomaly at Pintadillo 1. They've got Indico 1, which is with ONGC in CPO5, and the Mirapariba one in Put 8. Any or all of those would be extremely good news, so I'm very positive on that.
So on to Stephen Williams, co-chief of Reabold Resources, an investor in near-term high-growth upstream oil and gas projects. Well, you might say, aren't we all? But they have a particular game plan, and this is one which has come from somebody who has the ideal pedigree for this in many ways, because he was an investment analyst with lots of companies that we all know, M&G, Simmons & Company, Exxon Mobil, an asset manager with Guinness Peak Asset Management. One of those rather interesting people who, having done it in a city context, is actually, as we were talking about this before we started this evening, how you're actually having to sort of put your money where your mouth is and sort of do things as a chief when you're on your own. So very exciting. Tell us a bit more about the company, what you're trying to achieve.
Well, thank you very much. Obviously slightly unfortunate circumstances, in part because I haven't written anything down and I was relying on the slides to remind me of what to say. So perhaps I'll just give a slightly briefer overview of Reabold, and hopefully you guys can then help me out and make this a bit more interactive and ask a few more questions to try and prompt me and remind me of what I was supposed to tell you in my slide presentation. So we're relative newcomers to the junior oil and gas space. We really launched Reabold, or the Reabold strategy, in October last year, with the aim to provide funding for high impact but de-risked appraisal drilling opportunities. We've spent 9 months building a portfolio. We've got 6 distinct projects now in that portfolio. All 6 are independent of each other. All 6 will be drilled this year. So we've got 6 wells drilling in the next 6 months. All of it's fully funded. So we look forward to be able to give you 6 drilling results in the next 6 months. There's a considerable amount of embedded value in those projects, assuming that they go well, and we're looking forward very much to be able to give you those results shortly. Now, we did have a slide about the background that was briefly mentioned of Sachin, my colleague, and myself, which is coming from the investment community as opposed to a more typical oil and gas company background that you'll see at the other companies. And that's quite relevant because we have a different perspective on how to run a junior oil and gas company than most other management teams do. Now, the Reabold strategy is really 3 different strands that came together at the same time. So firstly, we saw an industry environment where pre-cash flow upstream assets were completely starved of capital, and that was indiscriminate about whether the projects and the assets were high quality or low quality. So what we saw was very high quality assets, high quality projects that were stuck for a number of years because there was no capital to take them forward. And this is despite the fact, this is what we heard from Malcy earlier, that returns are extremely good at the moment. So we have an opportunity at the moment to deploy capital into these high quality projects when the entry price to get into the project is extremely low, the operating costs are extremely low, and the returns are extremely high, the best we've seen for many years in the oil and gas industry. So that was the first thing, that's the opportunity we saw, and we thought, can we fulfill this and can we find some capital to put into some of these projects and take them forward. Now, secondly, we were lucky enough to be working at M&G, big blue chip asset manager. We were the energy specialists, and what that gave us was phenomenal corporate access. So we covered every energy company in the world, the biggest ones to the smallest ones. We had a global mandate, looked all over the world, and we spent years and years getting to know all of these different projects and investment opportunities. So we have the database of knowledge to pick the right projects to put into this strategy that I just talked about. And then thirdly, on top of all of that, we, like many of you, had experienced an extremely frustrating time investing in oil and gas companies over the last few years. Now, why was this frustrating? Not just because the share price went down and everything, well, that was obviously not a good start, but the really frustrating bit was we were getting right what we thought would be the hardest bit, which was finding the right projects. We were getting involved in good quality projects, the oil companies were doing the right things, de-risking the asset, taking it forward, and yet inevitably the share price would fall 90%. And I think the main characteristic we saw investing in the E&P space, particularly outside of North America, over the last few years is this huge divergence between fundamental asset and project value and share price performance and therefore returns to the investors. So we've constructed the Reabold strategy in a very specific way, which is completely designed to close that gap between the fundamental value we can create within the projects and that value coming back to Reabold and therefore to the Reabold shareholder. Right, so what specifically does that mean? What do we actually do that's different to everyone else? Well, firstly, we are completely focused on what we consider to be the steepest part of the value creation curve throughout the life cycle of each project. So in the current environment, we don't need to do early stage exploration. There's nothing wrong with early stage exploration, very important, can create a lot of value, but it takes a lot of time. It takes several years to take an initial concept through to the point of realizing value out of it. And typically companies have to keep coming back to either the market or the industry for more capital. So we miss that bit out. Now the other side of that is, of course, production assets. Now everybody loves production because it has cash flow associated with it. The problem is, if you try and buy a producing asset, everybody knows the value of it. It's sufficiently valued, it's fully valued, and many of the junior companies have found it's impossible to generate a return buying a producing asset. So where we want to be is right in the middle. There's a very steep part of the value creation curve at the moment where we can buy into very de-risked projects that are basically one well away from being able to prove that they're a monetizable asset. That's the well that we want to fund. We do that across a number of different projects, and we should see value creation very quickly and without the need, in the case of each project, to come back to the market for additional financing to take it forward. Another differentiating factor is, if Sachin was here, you'd be looking at the entirety of Reabold Resources. We don't have a team. What we do is we invest in projects that already have technical and operating teams associated with the project. Now, firstly, that allows us to keep our corporate costs extremely low and preserves all of our cash to actually go into the drilling. But just as importantly, it allows us to be very flexible, to keep layering on these different projects, so we're able to achieve exposure to 6 different projects all at the same time. And equally as importantly, will allow us to exit those projects. We don't have to worry about the team and the capability of how that works. We just exit the project that still has the people associated with it. And that brings me nicely on to the final point of differentiation, which is our willingness to exit projects at the right time. So we do not have we do not measure ourselves by common metrics such as reserves or even production growth. We measure ourselves purely on cash. So the idea behind the Reabold strategy is to put cash into projects and then take as much cash as possible back out of it again that can then be recycled into the next set of projects or distributed to shareholders at the appropriate time.
Okay, well, thank you very much indeed. That was a remarkably swift and interesting summary without slides as well, so thank you. I have one immediate thought out of that. Maybe we can see what Malcy thinks about this. But we heard at the beginning from Leo, they'd moved into some assets. They thought the management was a bit sleepy, a bit tired, they've been there a long time. You're relying on sort of existing management around wells and things. What if they're not up to scratch? That might actually stop them getting that strike or that gas that you need to generate the revenue.
That's right. So part of our project selection is making sure firstly that the rocks are right and the rocks will produce as we expect them to, but also making sure there is a capable management team ready to take it forward. That is part of the project selection, not dissimilar to how private equity works in terms of backing management teams alongside particular assets and relying on that management team to take them forward in an operational sense. I should note that you mentioned sort of sleepy management. I think that is a function also of the industry that we've seen recently. Whilst on an operational level, the actual operating of the assets in the field is left to the hands of the separate operating company. The strategic direction of the companies we're investing in is dominated by us and by our capital going in. So we take a lot of care to structure the agreements we have with these companies very carefully to make sure that the strategy is in place and that we can govern the use of our capital to make sure it's efficiently deployed and to make sure that Reabold sees the value of that return when the asset is drilled.
But of course, you're not geologists, you're not oil people. Do they take kindly to chaps in suits telling them to do the job better?
That's an interesting point, and again, that comes back to our background. So we were at M&G, we stuck with this sector, we stuck with junior E&P companies where no one else in the city cared about them because it was impossible to make money because they were in free fall. A lot of times companies were coming around on roadshows. We were the only institutional investors who took a meeting with them. That was it. They only got to see us. Nobody else cared. We as a result of that, have extremely strong relationships throughout the industry. And that's a key part of the Reabold story, really. Is that, without those relationships, it's very difficult to get these deals done.
Malcy, is this different to what you see with other companies?
Yeah, it's a whole new model, and that's why it went straight into the back of this. And I think that the excitement of 6 wells, the Canadian wells, I think they look exciting, but also in terms of what we're seeing in the States. I was saying to Steve before is that buying the Gaelic Resources business turns around a return in very good time. So I like the way you've got the spread across and in Europe as well, Romania.
Yeah, I mean, I think so. A couple of points on that actually. Firstly, with regards to the US, I mean, it's everything we love. It's an overlooked asset. It's extremely de-risked. There's a lot of historic production coming out that's come out of these fields. It's very cheap to drill. It's very, very fast to monetization. So these are the sorts of things that fit our strategy perfectly. The other thing that's worth noting is there is a lot of running room in California. There is a lot of assets available. California has a very unique dynamic. It's unlike every other state in the US in terms of the fact that there's more projects available than there are companies trying to do them. And so there's a phenomenal opportunity to grow that business in California. And just on Romania. Romania gets missed a bit, I think, by investors and people that talk to us. We often get asked, what's your favourite project? We always answer, we love all our children the same. They're different, but we love them. But actually, I have a bit of a bias towards Romania. This really is a fantastic opportunity. We're re-drilling existing gas discoveries that were never put into development. And again, it's valued as if this is a high-risk exploration asset. It's not. There is a gas field there. It's been drilled before. Gas has flowed out of the field. We've now got seismic over it, which confirms where it is. There's now been an independent experts report, a CPR, that we just put out last week, confirming the volume potential here. Very cheap drilling, easy to monetize, and that will again drill later this year.
Well, we didn't think it was the food in Romania which got you there. Question in the back.
To what extent do you dictate the commercial negotiations of operating companies? Do you act as their treasury? Do you dictate to them exactly how they should negotiate their commercial contracts?
It varies, right? I mean, the more day-to-day and operational it gets, the more we leave it to them. And the bigger and more strategic it is, the more we try and take control of it. The key point, really, in terms of what we try to control, is the use of the capital that we provide. So what we do, we don't just fund a company, let the management team have access to the cash balance, and then they can do what they want with it, right? So if you take Romania, for example, the £1.5 million investment, we agreed that contract, signed that contract last November. The vast majority of that cash is still sitting in our solicitor's escrow account. They don't have the cash yet. That cash is tied to a very specific drilling event. And that's how we control activity in the underlying.
Should they decide to expand and leverage, it will be the lenders who will dictate.
Well, but that company can't take on leverage without our agreement. So that goes in the shareholder agreement. Sorry, yeah. So in the typical shareholders agreement, given the size we are, we're a major shareholder in all of these things as well. We have a lot of, I guess it sounds bad, but it's reality, we have a lot of negative control. So there's a lot of stuff the company cannot do without our say-so. So we have anti-dilution protection. Major asset transactions can't take place without our approval. Leverage can't take place without our approval, etc.
Question at the back.
Yeah, Steve. Sorry, hello.
Yeah, hello.
You mentioned that you won't be frightened to sell your position. How do you go about doing that? Is it through public companies? Are you 100% owners of these companies, or how do you manage it? Because in Corallian, for instance, if there's a discovery, would you consider selling your position in Corallian? How do you go about doing that?
So it depends, and if you take Corallian as a good example, it really does depend. There's a whole host of outcomes that could follow a successful drilling event. So we are not predefining the most likely way of monetization of that asset, but I guess what I'm trying to say is that conceptually, we are very open to the idea of recycling and moving out of those assets, assuming the valuation is correct. Of course, we don't have to. We're also in that luxurious situation that we have a portfolio of assets now, which have different characteristics associated with them. So assets like those in California are monetized simply by putting them straight into production. So we've got that business humming away and running and generating cash, which means our hand will not be forced to make a premature decision on what to do with the Corallian stake in the event of success.
And what about all the complexity that comes from different rules in different jurisdictions about the oil price, how much you have to hand over to the government, taxation and everything? It seems to me if you've got lots of eggs in different baskets, that might make life extra complicated for an operation which is sort of you running around London.
Yeah, well, that's very true. I mean, I guess, again, we came, again, from fund management world. We were quite used to having 100 different investments that we were working at any one time. So the idea of how you appraise these situations, I mean, we have capacity to do a number of these, and that includes understanding the technical nature of the asset, the jurisdictional issues, and the management team. And then this is also the key to our model, is that we don't have a centralised team under us in London trying to run a business in Romania and a business in California and a business in the UK. They are three completely separate teams that are in each of the underlying companies that we invested in, and they are all focused on their particular jurisdiction and asset. And that's the beauty of the model.
Mr. Multitask. Who said men can't do it? Okay, lots of questions over here. If we keep the questions fairly brief and the answers fairly brief, we can get through them, because I know some of you are standing up and might find that uncomfortable. Okay, over here.
Hi, Stephen.
It's for the webcast.
Oh, sorry. Just a quick question. You currently have 6 projects. Can you give us an idea of the percentage ownership you have across those 6 projects?
Yep.
And when you sell one, I don't know how big your fund is. What's the likelihood that you're going to return stuff to shareholders versus making it grow at this stage?
Yeah, so the holdings are range from 29% in Romania, 33% in the UK, and 50% in the California businesses. The idea about recycling versus returning cash is a really important one. So I discussed right at the start, there's an opportunity at the moment, right, to fund these things at extremely low valuations, drill them very quickly, and get these monetization events shortly afterwards. That window is open. So if we were theoretically to sell one today, right, you know, for a big uplift, we would be very likely to recycle that, because the projects are there, the company, we're talking to the companies, they want the cash, the agreements can be put in place, everything can. Now, I suspect that that window at some point closes, or at least starts to close. And the reason is, we've got a higher oil price, the industry is feeling a bit more flush with cash, there's a bit more confidence around. I think other players in the industry will start to do deals on some of these projects, and we will see a little bit of asset inflation. The entire basis of our model is to be able to buy into this stuff at 0 cost, almost 0 cost. That's the basis. It's all about that sort of cyclical play. And as soon as we lose the ability to do that, we'll start returning cash rather than redeploying. And we get the question sometimes that says, well, this model doesn't work then, because what do you do if everything inflates hugely in value and your model's broken?
I was going to ask that.
Oh, good. Well, okay. Well, if everything inflates, then our projects will have inflated. So we'll have made everybody loads of money, so that's fantastic. And then what we'll do is we'll sell everything and we'll stop. We have no issue with walking away from this business once the job has been done. This is a cyclical play. There's no point in riding everything up and then being fully invested when everything collapses. I mean, that doesn't make any sense.
There's another question in the middle somewhere. I'll come to you next, because you did ask one before. But, no? All right. Okay, this gentleman here then.
The question that I'd like to pose is that the key thing here in terms of your structure is to exit. So when is the actual ideal time that you will be exiting? And so could you talk me through the process that you'll be taking for that, examples, etc.?
Yeah, so the ideal time, again, conceptually, because it differs asset to asset, is I talked about this value creation curve, and the value of an asset bubbles along very low value in the early stages of exploration. At the moment, it doesn't go up as things get de-risked, until you get it right to the point of it's now basically a production project. And then the value shoots up and reflects production in a $70 oil world, right? So what we want to do is get up that curve and then look to exit. Now, when we say exit, it doesn't necessarily mean we have to sell out. In the case of California, for example, those wells will go immediately onto production, and the monetization route there is to produce, right? So it differs asset to asset. In the UK, it's a slightly different story, because they then become development projects that require sort of tens of millions of dollars for us to hold our corner in terms of funding the development. And we think there's more efficient use of capital than that. So they're ones where we are more likely to consider either exiting or just letting ourselves be diluted down in the event of successful drilling. But again, there's lots of different options. So if Corallian drills a success on Coulter, for example, the asset could be sold, the company could be sold, as in Corallian could IPO, we could stay in, we could get out, we could sell our share. I mean, there's a whole host of different ways of getting out. But what we will be looking to do is maximise the cash return on our investment.
Okay. Any more questions? Okay, just one very brief one from me for Malcy. Well, Stephen, I'd get your take on this as well. I know you're very reluctant. We talked about this earlier. You know, you pick these companies, and your track record is excellent. You find it much more difficult. It's not your bag to do the timing. Of course, all investors want to know the timing. They don't want to be sitting on a stock that doesn't do anything. Just tell us a little bit about how you read the RNS, the results, everything that's coming out from companies. What are the signals that give you confidence or make you sceptical about a company in this space?
Briefly, the confidence is just unearthing the value, where I think that longer term that there's a significant value that you can see, whether it's in Reabold stuff or Lancaster for Hurricane or in Echo or so on. And the timing of it, as I said, is a different ball game. But the cynicism comes from management that either won't meet you or pass you on to other people, and there are plenty of those. I won't name them, but there are a number of them that you just don't. I won't write about a stock where the CEO won't meet me, and I think that's fair enough. And it's usually proved to be right. So, you know, you have to be cynical because I look at 100 stocks.
Mm-hmm. Mm. And I guess your relationships with investors, the kind of way you do that is borne out by your own experience of working with companies.
Yeah, in part. And I think, you know, the one thing, or one of the main things that frustrated us when we were on the investment side until recently, and I think is very true today, obviously I won't name specific companies, but what's frustrating for us is to see companies just not doing stuff. Just doing nothing. I mean, there's a sense in the industry, there was a big panic, the oil price collapsed, exploration couldn't get funded, farm outs dried up. So there was this sense of retrenchment and do nothing, and everybody retreated behind their doors, didn't speak to anybody, didn't do anything, and we saw cash balances basically dwindle away in G&A and nothing get done. And it's at the bottom of the cycle that it's hardest to do stuff, but it's at the bottom of the cycle that the best rewards are earned when you manage to carry out activity. So I think the key thing is just making sure that companies are getting after the opportunity that's in front of them today.
Okay, well, Stephen, Malcolm, you've done very well in difficult circumstances. Thank you both very much indeed. On behalf of London South East, I'd like to thank you all. You've been very patient. Obviously, it's been difficult for us. It's been brilliant that you've rallied round. I think we've heard as much as we would have heard. It's been an excellent session today. Don't forget, lots of content on the London South East website, not just on oil and gas, but there's stuff there on natural resources, biotech, Bitcoin, and more. Obviously, watch out for further events like this, and thank you very much for coming. Yep.